All right, I'll just have a crack and see how it goes. Should have my pitch right. Hi, I'm Hugh Bickerstaff. I've been involved in technology companies in Australia and venture capital companies for 30 odd years, and I have worked with some of the fastest growing technology companies in Australia. I've worked with some global companies as well. But also, I guess most notably launched a company with some friends back in the 1990s called the Volante Group, which became one of the largest listed IT companies in Australia. And since then I've been investing in founders and early stage companies to the point where it became a full-time occupation for me, and I was Chief Investment Officer for Investable, who are a seed investment company in Australia. And now I'm also working with a Singapore-based fund called Volpes Investment Management, which has a special opportunities fund investing in early stage technology companies throughout Southeast Asia and Australia and New Zealand. And it's really exciting times with COVID-19, which initially we thought was going to be a difficult time in terms of motivating investors and being able to travel and get in front of founders and so on. But we, like many companies during this period, have been able to adapt our processes and the way we operate to be successful during this period. And we've made 11 investments in the past 6 months. So it's actually been one of the busiest times and the best times to invest, while everyone else was worried and trying to work out how long and how deep the COVID situation was going to go. I'm also working as Chief Operating Officer for a software company here in Australia, a technology company called CloudWave. We work with customer experience, so basically a software as a service platform that provides contact center managers and contact center agents with a single pane of glass to manage the new omni-channel world that they're operating in. So, contact centers were traditionally call centers and based around voice, but the world's moved on quite considerably, and now we're looking at channels like email, like SMS and text and chat bots and social and so on, and integrating all of those into a single platform for contact centers is a massive challenge. So we're a cloud-based software as a service company. Moving to the cloud has enabled technology advancements which have been incredible in terms of being able to manage your customers and customer journey through all of those various channels and bringing them into a single platform. Yeah, the VC landscape's been really interesting, I think, for the past 12 months. The initial reaction to COVID-19 was, a lot of uncertainty, and people didn't realise how big COVID-19 was going to be or how deep the impact of it was going to be initially, and gradually we realised this is bigger than MERS or SARS or anything else we'd ever experienced. And international borders started to shut down one by one. Quarantine was introduced across the globe, and the numbers were frightening in terms of transmission. So that created an environment which business reacted to. Businesses reacted the way businesses do. They started to price in risk. Businesses started to reduce their costs wherever they possibly could. They got rid of any variable costs. Then they looked at fixed costs that were based around areas of their business that weren't going to be feasible in a COVID-19 world or in a post-COVID-19 world, and they jettisoned anything they could. The financial markets, behave the way financial markets do in that sort of uncertainty, and started to price in risk, and it was big risk and big unprecedented levels of risk. So, you saw the financial markets respond the way they do. Early stage investors, many of them, their portfolios were smashed, particularly if they had exposure to, live events or travel or any of the services that were impacted really heavily by COVID-19, or any of the businesses that were servicing those sectors that were impacted by COVID-19. So, it looked like it was going to be a pretty quiet year for investment, but, I think it's Warren Buffett who says, the best time to invest is when everybody's too scared to invest. And, at Volpez, who I was working with at the time, we launched a special opportunities fund. We tossed up whether we would go ahead or not based on our inability to travel. How would we make investments in Southeast Asian countries when we couldn't travel to those countries and meet the founders and understand the businesses to the degree that we would normally do. But like everyone, we found a way. Zoom was good for pitches. We started to leverage the founders that we had already invested in those geographies to kind of leverage their knowledge of the market and cultural and regulatory environments in those countries, and that was really useful, and it kind of motivated them to help us find better deal flow in their various geographies as well. So we found, having to adapt actually made us better. Our due diligence process, I think, became stronger with that network, and the way that we were also leveraging our VC network. So we were talking to the investors that were already working with those founders for a number of years and understanding how they were reporting, how they were leveraging advisors, and were they coachable, and all the sorts of things that how resilient was the team, what was the depth of the team outside the founder, all the things you normally try and do in due diligence, we were able to do by talking to early investors and other members of our network in those geographies. So it's been an incredible year. We made 11 investments in 6 months, and some of those investments have bounced back already to way above their pre-COVID revenue numbers, and they're operating with a much lower cost base because they have removed all of those costs from their business and haven't replaced them at the same pace. So whether that's going to be sustainable long term, we'll see, but certainly in the short term, it's producing some pretty spectacular results. I think the first thing that founders need to consider if they're going to raise capital from a VC is having a strategy and a plan for their capital raise. And that's super important because, it starts with how much capital do you need to raise? And that has a lot of variables around how much are you willing to dilute in this first round, what is your current burn rate, and therefore what runway are you raising to cover, and what is your proposed use of funds, and how is that going to impact your burn rate and your runway. So times are fairly uncertain, so I think founders have leaned towards slightly longer runways. They're looking at sort of minimum 18-month runway, and that helps you decide how much capital you need to raise. I always say to founders, the best form of capital is revenue, and if you have the luxury of bootstrapping your business and getting it to a cash flow positive point without having to take in additional capital, that's what you should do. If you have to take on capital, there is a lot of offerings in the marketplace today around both equity and debt. So there's a lot of revenue-based debt models that are available. There is venture capital available, there is venture debt available, and so on. So you've got to look at How much do I want to raise? What is the cost of doing that and the degree of difficulty of those different options, and what is the sort of downside risk of some of those options. But there's certainly more offerings available than there ever has been in the past. Once you've decided how much you're going to raise, you then need to look at your cap table. Do you already have anyone on it, or is this your first raise? Are you going to do a small round with just friends and family and fools, or are you going to sort of look at the next level up, which is the angel networks and angel investors, high net worths, family offices, maybe if you're doing a slightly larger raise again, or venture capital funds. And there are venture capital funds that specialise in pre-seed, seed, Series A and beyond. So you need to then work out who are the investors that you would like on your cap table, and who are the investors that your business is likely to attract. So what is the mandate of the various funds and the various people? And it's really hard to do because this changes quite regularly. Some funds are in the final stages of their fund, they're down to their last few investments, so they might be looking for something really specific, or they may have used up all of their overseas investment allocation and they've got to do local businesses. There's a whole lot of things that drive venture capital investors that are not always apparent. So you need to ask questions and understand whether you fit into their mandate. But also, I always say to founders as well, if you want investment, ask for advice. If you want advice, ask for investment. So definitely get out and have some conversations with various venture capital options, asking for advice on your proposed round if you can, and they'll certainly let you know whether or not you fit within their mandate. Look, there are definitely some red flags in early stage and private investment opportunities. There is, investors who are not going to add value to your cap table. I think often say avoid dead capital. There are investors who will put money in your first round but don't have the capacity to follow on and will not put money in subsequent rounds. They kind of become what we call dead capital on your cap table. Also avoid early stage investors who think that they're going to demand a lot of influence or a lot of pressure on your time, and they're going to ring you every week and ask you how things are going and so on. I think that can be a real distraction from your business, and can take a lot of time. Also avoid selling too much equity early on. It's highly dilutive and later on you'll really regret it. And also selling too much early stage capital to specific individuals. Like, I've seen people who have sold 30% of their company to Uncle Joe. Uncle Joe sitting on the cap table with 30% becomes a real barrier to venture capital and later stage investors. So if that can be avoided, I would. There's a lot of stories around predatory terms and term sheets that are unacceptable and potentially damaging. So my advice would be get good lawyers, get lawyers that are experienced in capital raising and early stage capital raising in particular. It'll be a good investment for you. A lot of early stage lawyers understand that they can wait to be paid until your capital raise is complete, or even sometimes until a subsequent capital raise. But having good lawyers who are experienced in this space working on your term sheet and your subscription agreement and shareholder agreement and constitution is really critical, probably the most critical thing. And I also would say try not to take on investors who are not going to be well considered by later stage investors. So, try and get investors that have a brand or a reputation that, or an ability to add strategic value and a background in the domain that your business operates in, or and that will add value to your cap table. One of the things I do every day, and it's probably not every day, but it's very, very regularly, and that is I have my fundamental beliefs in myself on the back of my mirror in the bathroom, on the inside of the mirror, so it's not publicly available knowledge. You have to sign a non-disclosure to be able to open the cabinet. But once you're in there, they've been very carefully and considered, the words that I've put in there around what I believe in about myself and who I am and what I want to be. So they're aspirational as well and carefully considered, put together with a professional coach, and after a lifetime of self-development and sort of self-awareness and development work. But they definitely remind me and guide me, and I try and look at them as often as I can.